The markets have been on a tear lately, with the S&P 500 and Nasdaq indices up 14% and 29% year to date respectively. And the Fear and Greed Index is at a score of 72, showing that extreme greed is driving the markets. But if we take a closer look, more than 85% of the gains in the S&P 500 year to date can be attributed to just 7 of the largest stocks in the index. And today, the top 10 companies in the S&P 500 index make up 32% of the entire index, which is much higher than the levels during the dot-com bubble or the great financial crisis. So from an investing standpoint, big tech like Meta, Nvidia, and Tesla don't look as attractive anymore. As such, we need to look elsewhere, outside of big tech, and for me, I find several small cap growth stocks particularly attractive. My name is Riado, and this channel is all about finding the companies of tomorrow. In today's video, I will be sharing with you 3 of the best growth stocks that you can buy today. And with that being said, let's not waste any more time and jump straight into stock number 1. So the first stock is Opendoor, which I added to my existing position a few months ago. Opendoor is the leading e-commerce platform for residential real estate transactions. It offers an end-to-end platform for people to buy and sell homes digitally without all the troubles of negotiating with different parties, renovating homes, or conducting open houses. So put simply, it offers a much simpler, faster, and more certain experience than the traditional process of buying and selling homes. So the company had a really tough 2022 and early 2023 as Opendoor dealt with raging inflation, interest rate hikes, and spiking mortgage rates that caused a massive decline in housing affordability. As such, there was lower demand for homes in the past 12 months, which is why Opendoor's revenue dropped significantly compared to prior years. As you can see, revenue growth peaked in Q4 of 2021 and then decelerated meaningfully and dropped to negative territory in the last 2 quarters. In 2022, revenue was actually up 94% year over year to $15.6 billion due to higher sales volume and higher average price per home. But that all came crashing down when the Fed began hiking interest rates at a record pace, which decreased overall sales volume and prices per home, which consequently led to a 39% decrease in revenue in Q1 to just $3.1 billion. But that's not the worst part. The worst part is that contribution profit, or how much money Opendoor makes for each home sold, turned negative for 3 consecutive quarters after posting positive contribution profit for, I think it was 20 straight quarters. So that was a big concern, and a lot of investors were panicking because Opendoor was technically buying too many homes and selling most of them at a loss. And as you can see, Q1 contribution loss was $241 million, which is a negative 7.7% contribution margin, and this is due to lower gross margins, higher direct selling costs and holding costs, as well as the company selling old inventory at a loss. So at first glance, many will conclude that Opendoor is pretty much doomed and will eventually go bankrupt. Well, on the surface, that may be true, but behind the scenes, things are actually looking really good for Opendoor. So Opendoor is operating at a loss due to the fact that the company is trying to clear out its old inventory, known as the Q2 cohort, which are the homes Opendoor acquired in Q2 last year, back when home prices were at peak levels, as you can see right here. And as you know, there was a housing correction in the second half of 2022, which is why Opendoor is forced to sell them at huge losses. As you can see, Opendoor is selling its Q2 cohort at a contribution loss margin of 13.1%, which dragged Opendoor's entire profitability down. On the bright side, Opendoor has already sold 92% of its Q2 cohort as of the end of Q1, so that means less margin pressure from its old book of inventory moving forward. In addition, its new book of inventory is selling at a high contribution margin of 8.5% as the housing market recovers, which means Opendoor will likely return to profitability once the old book is completely sold out. At the same time, according to Tyler Oakland, the founder of DataDoor, embedded margin, which is the listing margin of Opendoor's active inventory, is at the highest it has ever been. So that could possibly mean blowout Q2 earnings for Opendoor, which could be a huge catalyst for the stock. So I think there are brighter days ahead as Opendoor returns to growth mode and contribution profitability. And by the way, DataDoor is an analytics company company that tracks and estimates Opendoor data way better than Wall Street analysts, so if you haven't done so, give Tyler and Datador a follow. In terms of valuation, Opendoor now trades at an EV to sales multiple of just 0.34 times, which is way lower than where it was a few years back. So I think there's a large margin of safety for investors today. That said, I actually added to my position in Opendoor stock at $2 a share, and I'm planning to buy more if the stock pulls back in the next few weeks. Back in May this year, I did a DCF analysis on Opendoor stock, and I valued Opendoor at about $4 a share, which represents about a 35% upside from current prices. But after Q2 results, my price target may be revised higher. Also, if you're interested, you can watch my video on Opendoor where I talk more about Opendoor's financials, valuation, market opportunity, and so on. So you can find the link to that video in the description below, or you can click in the link right here. Another growth stock that is worth buying in my opinion is Marqeta, which is a modern card issuer processor that is disrupting the issuing facing side of the payment ecosystem. Oh, hello. Oh man. This is tofu, by the way. Okay. I won't go into detail on all the products and services that Marqeta offers, but basically Marqeta is a fintech company that helps other fintech companies and even legacy financial institutions to launch customized card programs that are highly configurable, scalable, and simple. And some of Marqeta's customers include Block, Affirm, DoorDash, Uber, Citibank, and more. As you can see, Marqeta's revenue trend is probably one of the most beautiful charts I've ever seen, with revenue consistently growing year over year and quarter over quarter. In 2022, revenue was $748 million, which is up 45% year over year, and in the latest quarter, revenue was $217 million, which is up 31% year over year. The strong growth that we've seen is due to higher total payment volume processed through the Marqeta platform, which actually grew 50% to $166 billion in 2022 and $50 billion in Q1 alone, which grew 37% year over year. So overall, very strong growth for Marqeta, but you may notice that growth is slowing down for Marqeta, and this is expected as the company grows over a larger base and faces tough year over year comps. And despite the robust growth, I do want to mention that one of the biggest risks in investing in Marqeta is that Block, which is formerly Square, accounts for 76% of Marqeta's revenue in Q1, so that is a huge concentration risk right there. At the same time, Marqeta is still very unprofitable on a GAAP basis. As you can see, net income margin has been pretty much negative, with net losses of $185 million in 2022, which is a negative 25% net income margin, and in Q1 it was negative $69 million, which is a negative 32% net income margin. This unprofitability is due to the company reinvesting into growth as well as high stock-based compensation, which is currently still more than 20% of its revenue. With that said, slowing growth, unprofitability, and SBC dilution are probably three of the biggest factors turning off investors today, which is why the stock has been underperforming the broader markets. But I think the issues of unprofitability and high stock-based compensation will soon be a thing of the past. For instance, in Q1, Marqeta announced that it will take restructuring actions to reduce operating expenses by $40 to $45 million on an annual run rate basis, which is already happening as I speak, which will eventually improve Marqeta's bottom line numbers. In addition, the world is turning increasingly digital, and companies all over the world need to adapt to that changing environment, including the shift towards fintech applications, which is going to benefit Marqeta overall. According to research, the embedded finance market is expected to grow from $63 billion in 2023 to $291 billion by 2033, which means a long growth runway ahead for Marqeta. That said, I think growth will still be robust for Marqeta, at least for the next few years, and the company is also well on its way towards profitability. And when the company turns profitable, I think it will be a huge catalyst for the stock. As you can see, Marqeta stock is still down like crazy, and it's priced as if the company is going bankrupt. But the matter of fact is, Marqeta is a high quality company with high quality customers that is growing rapidly with virtually zero debt as well as break-even free cash flow. So the chances of Marqeta going belly up is very slim to none. That said, I think the downside risk is quite limited, but the upside potential may be substantial. In terms of valuation, Marqeta is trading at an EV to revenue multiple multiple of just 1.4 times, which by historical standards is just too cheap to ignore. And back in May, my DCF model returns an intrinsic value per share of $9.52, which is a double from the current price of $4.70. As always, you can watch my full stock analysis on Marqeta, which you can find in the description below. Before we move on and talk about the last stock, I want to briefly mention the sponsor of this video, which is absolutely nobody. So if you're enjoying this type of content or if you find value in this video, I would appreciate it if you hit like and subscribe, as it really supports the channel and help me get closer to my goal of reaching 10,000 subscribers by the end of the year. And with that being said, let's talk about the last growth stock in my buy list, which is probably my highest conviction stock right now, and that is Hims and Hers. If you've been a follower of this channel, you know that I love Hims and Hers and that I'm long-term bullish on the stock. But in my previous video on Hims and Hers, which you can click in this link right here or find the link in the description below, I mentioned that I love Hims and Hers as a company, but I don't necessarily like the stock. As you can see, Hims stock has rallied more than 300% in a year, from $3 a share in May last year to about $12 a share in May this year. I felt that a rally of this kind seems unsustainable and that a correction is well overdue, which is why I sold my entire position at $12 a share, and I was also planning to buy Hims again at around $8 a share. And fortunately for me, this looks like the right call, and with the recent pullback, I can't help but to reinvest into the stock. So for the rest of this video, I'll briefly talk about why Hims and Hers is one of my favorite growth stocks to buy today. For those of you who don't know, Hims and Hers is basically a telehealth platform that provides patients access to high-quality medical care for a broad range of conditions, including erectile dysfunction, hair loss, and mental health, all at the click of a button. So the first major reason why I like Hims is that the company is growing at a massive clip. In 2022, revenue was $527 million, which is up 94% year over year, and in Q1, it was $191 million, which is up 88% year over year. As you can see, time after time, quarter after quarter, Hims continues to grow at high double digits with no signs of slowing down. However, I don't expect the company to keep on growing at this rate indefinitely. In fact, I expect growth to slow down over the next few quarters as the company grows over a larger base. With that said, growth was primarily due to the strong growth in online recurring revenue, and the keyword here is recurring. So over 95% of Hims revenue is in the form of online subscription revenue, as the company focuses on treating conditions that require recurring and ongoing medical care. And the growth in subscription revenue is of course driven by the increasing number of subscribers, higher net orders, and higher average order values. As of Q1, Hims and Hers has 1.2 million subscribers, which is up 87% from a year ago, with net orders increasing 70% year over year to about 2 million orders in Q1. At the same time, monthly online revenue per average subscriber and average order values are up 6% and 15% year over year respectively. And this not only shows strong brand loyalty, but also customers' willingness to spend more on the platform. So in short, Hims and Hers growth is staggering, and this is a testament to the company's unique value proposition as well as management's high-level execution. But moving on, the second reason why I love Hims and Hers stock is because the company has a high gross margin profile. As you can see, gross profit for 2022 was $409 million, which is a 78% gross margin, and in Q1, gross profit was $153 million, which is an 80% gross margin. Also, notice that gross margin has been improving over the last few quarters, and this is mainly due to increased order fulfillment volume from affiliated pharmacies, higher adoption of multi-month subscriptions, as well as a greater share of online channel revenue, which has a higher margin profile than the wholesale channel. Whatever it is, the high and improving gross margin profile of 80% means two things: economies of scale and high earnings potential, and that will certainly reward shareholders in the long run. One caveat though, Hims and Hers is still unprofitable on a GAAP basis. As shown here, net income margin is still negative, with net margins of about negative 5% as of Q1. However, things seems to be trending in the right direction, and it won't be long before Hims turn profitable profitable. Besides, HIMS is already profitable on an adjusted EBITDA basis, so the improving profitability also means that HIMS is gaining operating leverage within its business model. In terms of valuation, HIMS is only trading at an EV to revenue multiple of 2.5 times, incredibly cheap for a company that is growing 80% plus, has a high gross margin profile of 80%, and is about to turn profitable. And back in May, my quite conservative DCF model valued HIMS at about $20.66 a share, which is more than double the current price of $8.22. So plenty of upside from here, especially with the recent pullback. Again, you can watch my HIMS and HERS video for more details on my DCF valuation model. So there you have it. These are the 3 best growth stocks that you can buy today. They are still significantly below their all-time highs and certainly well below their intrinsic values. But do note that these are risky investments, particularly because they are unprofitable small cap stocks that are very volatile, so these are more suited for risk-tolerant investors. However, fundamentals are improving, they have a massive growth runway ahead, and they all look very undervalued, which is why I have big positions in each of these 3 stocks. With that being said, what is the highest conviction growth stock in your portfolio today? Be sure to let me know in the comment section down below. Otherwise, that's all that I have for you today. If you enjoyed the video, please leave a like and subscribe. And as always, I appreciate you and I hope you have an amazing day. Thank you, and I'll see you guys on the next one.